Gold is on an historic rally right now. Gold prices have risen nearly 70% since February 2024, briefly hitting a record high of $3,500 per ounce. That steep incline is one of the biggest rallies ever for the precious metal since gold's rapid appreciation in the 1970s. That rally in the 1970s came after Nixon ended the gold standard and during a massive wave of inflation, both of which drove a wave of speculation on gold as a safe haven asset that would retain its value. But the scenario today looks very different. So, what's different today? And is this gold rally likely to continue? Gold is considered a safe haven asset. That means it's considered low risk and is expected to at least hold its value, so investors flock to it in a risk off environment. Historically, this has happened when inflation heats up. This is pretty clear when you look at gold prices in the 1970s. Add inflation, and you can see a clear correlation. As inflation went up in the early 1970s, gold prices followed. The same thing happened again in the early 1980s, with inflation spiking to a whopping 15%. Gold prices shot up as well. This shows that investors saw gold as a hedge against inflation, and this has long been the general wisdom. But things don't look quite the same today. In recent years, gold prices have been moving more or less independently of inflation. This chart shows us gold prices and inflation since the early 1990s. As you can see, they don't seem to follow each other. For example, gold prices rose steadily from 2002 until 2012, while inflation went on its own turbulent up and down trajectory. More recently, we can see that there was no spike in gold prices during the post-pandemic inflation wave as you might expect for an inflation hedge. So what's going on? Why is gold rallying if the reason isn't inflation? Well, let's take inflation off the chart and add another line that gold does follow. This is the US debt-to-GDP ratio. It's a measure of how debt burdened the US government is and its ability to manage the balance it owes. A higher debt-to-GDP ratio is a red flag because it means the government is struggling to pay off debts. And in the US, it currently sits at 124%. That means US debt is 1.2 times larger than the entire US economy. As you can see, the price of gold shows a pretty close correlation to this ratio over the past few decades. Why? The answer lies in US Treasuries. Both gold and US Treasury bills are considered safe haven financial assets. So investors flock to both of these assets when they have low appetite for risk. But as US government debt has accumulated and surpassed GDP, Treasuries are no longer considered quite as safe, because trust in the government's ability to pay off the debt has deteriorated. So investors are shifting more towards gold as a go-to safe haven asset instead. Now, what does this mean for the price of gold going forward? Let's consider the short-term and long-term scenarios. Look at this chart, which shows the projected debt to GDP ratio. The US debt pile is set to keep growing for decades ahead. That would continue to erode trust in the US government and undermine the view that treasuries are risk-free. But what if the government figures out its debt problem and manages to reduce the debt to GDP ratio? This would be bearish for gold. To do this, the US government would need to make significant reforms to its budget, increasing revenue by quite a lot and/or reducing its spending. Both are possible, but each presents some difficult challenges. Raising more money for the government would involve some form of tax increase. President Trump has instead promised to lower taxes or eliminate income tax altogether. That would saddle the government with bigger deficits and more debt unless it was offset in some other way. The current plan is to replace income tax with tariffs, and these are already rolling out in a big way. But there's no realistic scenario where tariffs raise more than around $400 billion a year. That's far short of the $2 trillion needed to replace income taxes, likely increasing deficits. Reducing spending is another option to reduce the debt burden, but budget cuts are politically fraught and tend to take a long time to enact because many of them have to pass through Congress. As head of the Department of Government Efficiency, Elon Musk set the lofty goal of cutting $2 trillion from the government budget. But after trying for a few months, he reduced that goal by 85% to $150 billion. This goes to show how tough it is to reduce debt. All of this means that in the long term, investors could continue to consider gold as an asset to protect their portfolio from excessive government spending. At Capital.com, we'll keep you updated on the price of gold, along with other assets and market trends. Hit subscribe to stay tuned for more. Thank you for watching.